Hello, folks. I'd like to welcome you to this next segment of the Denny Artachi Show. We've been enjoying the podcast. And, today I have a very special guest. I always enjoy when this guy speaks, I listen. So who we have today is Paul Meeks. Paul is a 32-year analyst and portfolio manager. He's best known for technology stocks. In fact, at one time, he had the largest technology fund in the world. And this was back in his days when he was with Merrill Lynch Investment Managers, which was then acquired by BlackRock. But Paul is also an academic. He has great taste in music. He loves rock and roll. Since 2021, he's been the professor of practice in the accounting and financing department in the Baker School of Business at the Citadel in Charleston, South Carolina. Man, that's a mouthful, Paul. He's been an adjunct faculty at the Citadel, the College of Charleston, or Western Washington, since 2005. So Paul teaches accounting, corporate finance, personal finance, investments. He also supervises Student Management Investment Fund. He lives and works in Charleston, South Carolina, which I bet you have a couple of good golf courses there, Paul. He's originally from Western roots. His roots are in Western New York. And Paul joined Independent Solutions back in 2018. He's great with my clients. He's so, the thing about Paul, he has a good dial into what's happening in the market. He's featured on CNBC since the 90s, pretty much every week. And even though he's known for technology, Paul has a dividend model where he picks companies and equities that are typically with a 5% appreciation potential that are already yielding 3%. And why is that important? Well, for those of you who cannot stomach the ebbs and flows of the market, these are some of the other things that he has available through Independent Solutions. So it's always a pleasure. Like I said, since the 90s and the bubbles, Paul has been featured on CNBC often. And Paul, are you there, sir?
I sure am. Thanks for having me.
What a pleasure. So, Paul, I think you told me just recently that you've been kind of staying on the sidelines a little bit because ever since Thanksgiving, the market's kind of not been so hot. Is that still your take on it?
Yeah. As you mentioned in the intro, I manage tech money. That's what I'm best known for. But I also have learned over the years to have a plan B, so I run dividend portfolios. So particularly in my tech portfolios, I got a little queasy as we got into the very end of 2021. And frankly, I was worried more about Omicron than needed to be as we get into 2022. But what's happening is there's really been a meltdown in tech and other aggressive growth stocks really ever since Thanksgiving last, because inflation and interest rates are clearly on the rise, and that dings the valuations of these types of stocks the most. And so I'm sitting on a pretty large cash cushion right now, waiting to buy some of my tech favorites a little bit lower, because unfortunately, I think they may go at least a little bit lower.
Now, you're kind of waiting for the earnings report, which is due out, in another week and a half, 2 weeks?
Yeah, so I'm waiting for two things. I'd like to see some sort of short-term plateau in interest rates, right? I don't need them to rise to any specific level. I just need them to plateau and actually stop rising, at least in the short term. So that's one catalyst. And then, Denny, the other catalyst that you mentioned is spot on. We're right in the middle now of quarterly earnings reports for companies that had quarters ended December 31. And I would say that we probably have 2 to 3 more weeks left of this whole, I call it a confessional. Because sometimes companies, when they announce these quarterly earnings, they really disappoint by something bad that they say. And unfortunately, a lot of companies are saying some nasty things. And I don't want to be the guy that steps into a Netflix or a Facebook the day before they announce earnings and the stock goes down 20 to 25% the next day, which happened in both those situations. So I feel better about separating the wheat from the chaff in about 2 to 3 weeks when my final followed company has finally reported its results.
Now, for those who are maybe aggressive or the speculative side, they're probably going to try and guess what the earnings are, but that's not really what you do, right?
Well, I usually, because I've covered these companies for so long, have a pretty good sense. But right now we're in a really squirrely period, which takes, unfortunately, my experience out of it. Some of it is microeconomic stuff, which means it's happening at a company level. And some of it's macroeconomics, big picture stuff. And unfortunately, that's what I'm struggling with the most. And so I don't really have any control of that, because if you're a good analyst, you can't do much about the macro. It just happens to you. You can only focus on the micro, the company specific. But right now, frankly, the big picture stuff prevails, and it's just got me too scared to play.
Now, it's interesting. You mentioned rate hikes. I think a lot of people are guessing that we're going to have 3 to 4 rate hikes this year. Do you think that's possible?
Well, I think it's actually more than that. If you take a look at the Fed funds futures, the Fed is the Federal Reserve Board, the central bank. We're probably, if you are bearish and aggressive, and I know some of the strategists on the Wall Street feel this way, some firms have penciled in 7 to 8. And so they'll definitely start raising rates at their next meeting, which is in the middle of March. And I think they'll probably raise the Fed funds rate 1/4 percentage point each meeting. And these meetings happen about every 6 weeks or so. For at least several meetings and maybe pretty deep into the year. So I expect it to be more aggressive as far as the level that interest rates increase and how many times they do it. And that's why I've been kind of waiting in the weeds to get a clearer picture. But the next meeting is the middle of February, and they definitely, I say definitely, that's my opinion, will be raising rates for the first time then in really long time, many years.
Now, some may say that a lot of analysts have already factored that into the market, and they've already put that in their evaluations. But, I mean, honestly, if we do have some rate hikes, shouldn't that affect, equities in the stock market?
Yeah, and it already has. And the worry about such has essentially knocked stocks down, particularly the aggressive growth names and the tech names, ever since Thanksgiving. And so, yes, as soon as people get queasy, they start to sell off. And you could say that the bad news is already in the stocks at this point because, it's no surprise. But I want to wait a little bit longer, at least a little bit longer, because I want to have at least a little bit more info about inflation and rates before I swoop in, just to make sure that I'm not getting in a little bit early, because it's just really confusing and frankly a little scary right now.
I would say so, because look, if the cost of goods are going up, and they have been, I'm not convinced that we're at a 6% inflation rate when used cars are 30% and real estate is 30% and lumber has gone up, gas has gone up, groceries have gone up. That has got to affect the bottom line on these companies trying to make a profit, which of course will mean that they'll have to raise the prices for their goods, which of course will mean that consumers may be spending less. Isn't that a reality?
Yeah, that's definitely a reality. And you have to look at each company and each industry, because some companies have quote unquote pricing power, where their product is in such great demand that they can raise prices to pass along increased costs, and the consumer keeps buying. But there's other products where, there are substitutes where you're absolutely right, Benny. People will say, whoa, no thank you. And all these companies are announcing in these quarterly results that I'm listening to the last couple of weeks that they're really being dinged on being forced to pay higher wages for employees. And also if they're, buying goods on a wholesale level, that their costs are going up. Like Unilever, which is, well-known bunch of brands like Dove soap, for example.
Mm-hmm.
And then they talked about, and they just announced results a couple of days ago. They talked about extraordinary increases in their cost of goods. And so,
It's funny,
they're going to be done.
not that I frequent it, but even fast food restaurants like McDonald's and other ones, they're going to do away with the dollar menus because their profits have been, everything has been forced higher with this inflation problem. Now,
Yeah.
here's the interesting thing. Besides inflation, they're no longer going to do stimulus, so people are going to have less money to throw around. I never understood how it's good for the economy when consumers spend frivolously and raise up debt. But it's looking like if inflation continues and the prices keep going high, that people are just going to spend less. And again, that should affect the bottom line of companies. But you have always taught me that the federal funds and what the federal does is more important than who's in political office and so many other things, right? You still believe that that's the driving force in the market.
The Fed's controlled monetary policy, which think about that as manipulating rates. You lower interest rates to juice the economy. You raise interest rates like you do now to rein in inflation. I teach college finance, as you said, and I put a photo up the first day of class of the chairperson of the Federal Reserve. Right now, it's a guy by the name of Jay Powell. Of course, the students don't know who the guy is. And I say that this person is the most important person on earth in finance. And the president of the United States, whether it be Trump or Biden or whomever, probably is not even in the top 20. And so, yes, monetary policy has been so important. That's why we're watching it. And you're absolutely right. Fiscal stimulus, which is controlled by Congress, whereas monetary stimulus is controlled by the Fed. Looks like the fiscal stimulus is done, right? All those programs to rescue people from COVID have wound down. And so we no longer have that hurricane wind at our backs. And then we're also simultaneously tightening monetary policy. So we no longer have that benefit. It actually becomes a headwind. And so, two hurricane force winds that were helping us are now going in the other direction, which is a little bit nerve-wracking.
It's interesting because, there's a lot of speculation. Obviously, they were talking about raising taxes. They were talking about doing many things. They really haven't passed anything in the last year. They've only been talking about passing things. So do you think and again, you and I don't like politics, but do you think if the Republican Party takes over the House and the Senate, that could affect investor sentiment or the markets in any way?
Yeah, I think Biden, no surprise, has pushed at least a partial reversal of the tax cuts that were enacted under Trump in 2017. But you're absolutely right. So many things have been going on: Afghanistan, Ukraine, Syria, all kinds of madness with Omicron coming back to haunt us. That all his talk when he first came into office about getting on Congress and lowering taxes, that won't happen. And they'll be pushed off. And if the Republicans come back in, it won't happen at all. So, I think even though people are kind of giving up on even the Democratic side of the House, that they'd be able to get these tax raises up, I think if the Republicans come in, they'll say, oh, okay, well, now there won't be any tax hike, so we're good. So I think you're right. Those people will feel a bit relieved.
Well, here's the thing. I think as recent as, let's say, 2 months ago, a lot of people still felt that we could have high single-digit returns in the S&P and equities market. But the Nasdaq itself has taken it on the chin the last couple of months, has it not?
Yeah. And again, it wasn't a phenomenon that happened on January 1st. It wasn't that clean. It's actually a couple of days before Thanksgiving is when we had this break in tech and aggressive growth stocks. But since then, some of them have been crushed. But even the average tech name since Thanksgiving has been down probably somewhere between 10 and 15%. Thus, the reason I've been, trying to cool my heels and wait for, a brighter day. Yeah, I still think we could have a decent year in the market. We just have to get through this transition from monetary and fiscal stimulus to the reverse and all this nervousness. I mean, it was bound to occur, and it's occurring now, and I just don't know how long it is. But as soon as people adjust, then they'll be safe to get back into the water again. I just think it's probably at least a couple weeks out, maybe a bit longer. I don't think you can necessarily worry about writing off all of 2022. I think 2022 won't be as good as last year. Still might be all right in the end by the time we get to December 31.
So if you were to guess where technology is going to wind up this year, what would you say?
I would say that we're having to dig out of a very big hole.
Okay.
I think technology will underperform the S&P 500 this year, which is saying something because in all the years prior, technology has always been the best sector of the 11. I think technology will have a rebound, not all the stocks, but a select few. I'll try to figure out who those are. But at this point, I think value outperforms growth, and other sectors, for the first time in a long, long time, outperform technology this year. I think technology will come back, but climbing out of such a small hole, even though I think it's going to be positive for the year, is not going to allow it to have a big number. You're starting too deep in the hole.
So what about financial? I mean, if they raise rates, that would be good for bank sectors. Are there certain sectors that you think should do well with all the volatility that's going on this year?
Yeah, you've already seen it year to date. So, just since January 1st, there's 11 economic sectors that comprise the economy and the market. And there's only two that are up. One is energy and the other is financials. All the other 9 are down, and tech is down considerably. And so, what happens with the financials, not the investment banks, because they're dependent on IPOs and investment banking and such, but your neighborhood bank, the commercial bank, the small bank, not the Wall Street bank, that all they do is take in deposits and lend out money. As interest rates rise, they should have a greater spread between their cost of borrow and their cost of lend. So, yeah, banks could do well, but not the investment banks. Your community bank will do better. And, of course, the price of a barrel of oil keeps on rising. And energy killed it last year, and it's killing it so far in 2022. And so, the big oil, the kind of companies that everybody hates because they're killing the environment, they've actually been the stars, for about a year now.
I think the only people that hate that sector are the ones who do not have it in their 401ks or their IRAs. I think most consumers are okay with oil going up in energy stocks.
Well, for many years, they were the greatest laggard, and technology was the greatest winner.
Yeah.
But that has reversed. And 2021 was very good for energy, and 2022 so far is also very good for energy. Some of these companies like Chevron and ExxonMobil, who nobody cared about, have been doing very well. And the nice thing about energy is those stocks typically also have very high dividend yields. That's just kind of the nature of the energy business.
Well, that leads me to my next question, because I know that you and Peter Nielsen are working on a different type of style. Why don't you talk about what you and he are focusing on? I guess you two are trying to be contrarians with what you're working on. But why don't you talk about the new direction that you and Peter are doing as well?
Yeah. So one of the things I learned as a much younger man, I was managing a ton of tech money, the biggest tech fund on earth back in the late 90s. Mm-hmm. And of course, that was great. And then the internet bubble popped, and I became the most hated person on planet Earth. So I said at that time, I got to be more diversified. I can't just be all tech all the time. I've always tried to develop, at least in recent years, a plan B. And that's what Peter and I worked on. And, we're looking for those among the 11 sectors, which ones will be beneficiaries in this era of higher inflation and higher rates. And that gets you to commodities, energy, and financials. And then we're also looking for companies that have a dividend yield higher than the market. So they have to have a yield at time of purchase of, think 2 to 3%. And then, of course, you don't buy a stock just to collect the coupon. It's not a bond. You also hope that the price goes up a bit. So, yeah, we try to find those. Most of them are American companies. Some of them aren't. And it's really been a paradigm shift with this move from growth to value. So we're trying to capture it and reposition for it.
You still feel pretty good about international equities?
Yeah. Yeah, I would say that there's a couple of things. First of all, not just the international developed markets, but the emerging markets that underperformed the United States for quite a while. So they were due for a little bit of comeback.
Okay.
Also, we talked about monetary and fiscal stimulus in other parts of the world. They're not aggressively raising interest rates like we are. They might be a couple years behind us. And so they're still in an era of fiscal and monetary stimulus where we are in an era of fiscal and monetary tightening. They should do better, right? Because they still have the assist and we don't. And also, the sectors that we highlight, they actually play well to some of the strengths of abroad. Right? There's a number of big energy companies abroad, some financials, some commodities plays, because some of these foreign countries, their economies are driven by commodities. And so they don't have tech like we do. There's no Silicon Valley. But in the areas where the puck is going to, they might be pretty well positioned.
Interesting. Well, look, even though we all feel interest rates are going higher, bonds are still not that attractive, are they? For those thinking...
No, but interest rates are rising, so bond yields over time will rise, but they're coming from such a low rate that it's still not very attractive. Like today, the yield on the U.S. 10-year Treasury note, which most people think is the benchmark rate, is still only 2%. Now, it started 2022 at 1.5%, so it's kind of 0.5% in a month or so, which is actually a pretty aggressive move. But still, 2% is no big shakes. And so I think what happens is interest rates have to rise a lot more. And then at some point, the coupons that are being paid on your average bond will be much higher and actually more attractive than the dividend payments on stocks at that point. And then you do a switch. But I think the switch into fixed income is still a year or so out.
Apparently, yes. So, look, I guess if things get really bumpy and shaky, because you're right, we don't know what's going to happen in Ukraine. We don't know if there's another variant coming about. I mean, my God, the way some of the news portrays it, they never want COVID to go away. But I am hopeful because recently even Dr. Fauci was stating that we're close to stopping all the mandates. So maybe we can look at it in a rearview mirror that we won't have another version of COVID around the corner, which will disrupt jobs and so many things. But we just don't know.
Well, when you think about it, what we call flu today, right?
Yes.
That's common vernacular. That was, a pandemic in 1918.
Yeah.
And then there were variant and variant and variant over all these years. And now it's kind of dwindled down to, hey, it's the flu and it's November. And so I'm going to go to CVS and get my flu shot and I'm done.
Right.
Sooner or later, I think we'll have more and more variants. They'll be more and more diluted. And a couple of years from now, we'll say, hey, it's November. Let's go to CVS and get my COVID shot. And then we'll call it done for the year. That'll be how it works out.
So Paul, devil's advocate, what could get in the way of this market? Like, what do you fear could happen that would really shake things up going, in this next, this year and going forward?
I think the anxiety around the potential warfare, which would be really a Cold War like we haven't seen since the Reagan era. If,
right.
The Russians attack the Ukraine and we decide that we have to defend, and then even the Chinese get in the mix. That's a three-headed monster. So that worries me. And then the other thing is there is no doubt that inflation is high, right? We see the stats.
Yes.
How much of it is based on permanent stuff, so it'll never go back to the old, and how much of it is based on just temporary stuff, like when COVID goes away, the supply chain will be unclogged, and then prices for your, like, as you said, the used cars will drop. So if I'm wrong, and a lot of this inflation does not go away when COVID goes away, then that would be a risk, right? Because then inflation is permanently high. It does not subside. That would be a big, big risk. But I'm hoping that a lot of it goes away once the supply chain is unclogged.
Yes, the supply chain where the truckers can deliver and they're not backed up in these shipyards and things like that.
Oh, it's crazy. I'll give you a great example. This is a global stat, not a U.S. stat.
Mm-hmm.
So last year, the global automobile industry lost well over $200 billion, close to $300 billion in sales, because they couldn't ship cars because they were missing semiconductors. So today, the average sedan goes for about 40 grand. And sometimes a car company loses that sale because they can't get a $1 chip. Because they can't get those semiconductors from Taiwan or South Korea or China.
I remember you were talking about this 6 months ago. Have they caught up, or is it still a shortage of that supply?
Well, still a very bad shortage. And Ford just announced, when they announced their results, which is only the last couple of weeks, that they're going to at least temporarily shut down the production of the F-150, which is their moneymaker truck.
Sure.
Specifically because they still can't get the damn chips. So sooner or later, I think it'll be unclogged, and that won't be an issue. But you can just see how it's wreaking havoc with these manufacturing companies that need these semiconductors.
Well, whenever we get someone like you on the phone, even though you don't have a crystal ball, you're not a genie in a bottle, do you have certain stocks, companies, or sectors that you're really thinking it's good to buy right now for the future?
Yeah. Even within the technology space, some of the companies I follow have already announced their results. So it's rear view mirror, right?
Okay.
I can now plan because I'm no longer anxious. They finally gave me the news, whether it's good, bad, or indifferent. And I thought in my sector, Microsoft, Google, which is now called Alphabet, and Apple had really impressive results. And I also, and this gets into my little tidbit about Ford and the F-150, I also very much like semiconductors and semiconductor capital equipment companies that provide the equipment to build the semiconductors. Because I do think, even though the supply chain will become unclogged, those little chips have become really, really important in our life. And I just like the way that industry is positioned going forward.
Interesting. Well, that's great. I know that Independent Solutions just keeps growing and growing. You've got a lot of great stars in your lineup and lots of good experience. I'm always grateful to speak with you. And before I let you go, if you have anything you want to announce, either about Independent Solutions yourself or something that people should pay attention to, by all means, let us know.
Well, I'll tell you a funny thing that the whole world is looking at us, and I'll tell you why. I'm going to do an interview in about 3 hours.
Okay.
With a television station in Singapore.
No kidding.
So when you see, little old me doing, Asian middle of the night interviews, that's telling you that people are uber worried about tech and what's going on in the United States, well beyond our borders.
I believe that. Yes, the world is watching. We've had some emotional roller coasters in our country, and again, you and I don't like to get political. Some of our friends do, but we don't, because at the end of the day, I like to focus on what I can control. So no matter what laws they pass or what things that they're doing, I'm going to still remain calm and work with my clients and work on the things that I can. But yeah, that doesn't surprise me that the world is watching us very closely. In fact, they've probably been watching us very closely, not just the last year, but for the last 3, 4, 5, 6 years.
Oh, yeah. And what'll happen is we're going through a tough time. And as always, the market will overreact, right? The proverbial throw the baby out with the bathwater. And there might be some awesome opportunities because people just sell indiscriminately and say, oh, my goodness, that stock, which is a great company, got down to that level. We got to buy it with both hands. So I think it'll give us a few of those opportunities.
Well, exactly. So again, if you're investing for the next 5 or 10 years, I mean, Paul, do people in your position really even trade anymore where you buy something for 6 months to a year? I don't think so.
Oh, no. But you still, if you have fresh cash,
Yeah.
and you got to put it to work for the first time, right? Where you're going, from 0 to 60, at some point you have to plunge in, even if it's for a long term. And I just don't, even with those initial investments, I'm just not comfortable to do it these days.
Sure. Well, always a pleasure, my friend. Let's reconvene in a couple of months. Good luck in that Singapore interview. You're a rock star, Paul, and I'm looking forward to see you at the end of April. And Regina and I, we're still talking about what the theme's going to be music-wise, but
Well, bring your guitar.
we'll sneak in rock and roll, okay, no matter what the theme's going to be, okay?
There you go. Look forward to it.
Always a pleasure, my friend. You take care.
All right. Thanks. Bye.
Thank- Paul Meeks, ladies and gentlemen. So, look, most of you out there should have a professional advisor, and, I love to speak to people like him that are at this high level. And it's always good to diversify. Like Paul even says, there's times when certain sectors are hot, the following year they're not. So the key and secret is to have a well-balanced portfolio and make changes accordingly, not just to the market, but how things can change for you in your life. My office line is 561-537-5897. That's 561-537-5897. And I think my next podcast guest we're hoping is we're going to have a tax professional talk about some of the changes that they're talking about doing and what you can do for the taxes for 2022 and beyond. As always, thanks for listening in and make it a great day out there. And thanks for listening to the Denny Artachi Show. We'll see you next time. Thank you.